Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is David Auerbach. He's with Hoya Capital and also the Daily REITBeat. What you're going to find out is we're going deep on REITs. And if you don't know what a REIT is, I'm going to set it up before we get to the intro. It's a real estate investment trust. These are companies that own, operate, or finance income-producing real estate across a wide range of property sectors. You're going to hear all about it right now. This is episode 248 of Zen and the Art of Real Estate Investing with my guest, David Auerbach. David is the Chief Investment Officer at Hoya Capital. He's been in the REIT industry for almost 25 years, and he publishes the Daily REITBeat Newsletter, a widely followed industry publication that covers, you guessed it, publicly traded REIT sector. He's also a consultant with Auerbach Consultants. David, welcome to the show.
Jonathan, thanks for having me. It's great to be here.
Yeah, well, I want to get in on this REITBeat because it's not something that I am fully versed in, and I hope my listeners are along with me. So just tell us about how you got into REITs and why, and then we'll kind of get into what they are and the background and how they're interesting in today's market, as we were just talking about.
How much time you got?
Yeah, a lot.
So my road to get to the REIT industry is kind of winding. My Wall Street journey started when I was 6 years old, actually. When I was growing up, my father would put the Wall Street Journal in front of me with all the stock tables. Yeah. And I remember being fascinated by seeing Boston Celtics, or when he'd show me, look at this one stock price and look at how it's so much bigger than everything else. And it wound up being Berkshire Hathaway. Yeah. And being educated at a very young age about the stock market. And I remember growing up when I would go into elementary school, kids would usually be watching cartoons before school starts. And I was watching CNN Money, or that version of it way back in the day, because I was just so fascinated by the markets. Fast forward, going to college, I knew I was going to be on Wall Street in some capacity. I started out as a retail advisor, managing mom and pops, grandma and grandpa, whatever you want to call it. And I remember it was my first couple of months. I'd have my licenses. I know I'm better than anybody. I know everything. Yeah. Let's go. And I remember a prospect reaching out to me and they wanted to have lunch. And I told my boss, hey, I've got a lunch date today with the prospect. And he goes, no, you don't. I'm like, what are you talking about? He's like, you want to network? You want to build a book of business? That's on your time, not on my time. And I was shocked.
Yeah, I'm shocked.
I don't understand. My book is your book. Right. Any commissions we get goes to the firm. This is your business. He goes, you're right. And if you want to build a book of business, that's on your time, not on my time. And I said, that is the stupidest thing I've ever heard. Yeah. Networking is a 24-hour-a-day job. And I'm not about to call this prospect and tell him that. He goes, well, look, there's the door, my way or the highway. And I said, again, that's the stupidest thing I ever heard. P.S. The next day, literally the next day, I got fired. And back in the day, if you recall, when the newspaper used to publish daily classified sections of jobs and all that stuff, there was a job posting in the Dallas newspaper that I'm not exaggerating. It was 2 lines, 1-inch font, and it was like, have Series 763, call this number. Called the number, asked for an interview. They invited me in, nailed the interview, and it wound up to be a trader on an institutional REIT trading desk here in Dallas for a firm called, at the time, Green Street Advisors, what's now known as Green Street. Yeah. And I remember the first day I started, it was the day the market crashed in March of 2000, and my boss tells me, literally, word for word, kids your age don't get the opportunity that you're about to be given. In the same breath, 5 minutes later, one of the guys on the desk comes up to me and says, don't get comfortable. This business is going away. REITs are going to be gone in 5 years. Who cares about REITs? Well, fast forward to 25 years later, and here we are still talking about REITs. So he was wrong on that. But I was very lucky because when I started in the REIT industry as a junior trader on the desk, it wasn't like what we know the REIT industry today. Probably half the number of companies, probably more than, 1/3 of the number of investors that are existing today. It was a whole different world. And so, again, to watch these companies come public, go through various crises like 9/11, housing crisis of 08, 09, 13, 14, you name the story. It was interesting to watch how these companies evolved over time. Deleveraging balance sheets, growing dividends, focusing on the story, the narrative, the communication to the end investor and how they would educate. Look, we don't care about where interest rates are at or the 10-year treasury. We're focused on fundamentals, on operations. And those types of things have resonated with me that I've been very lucky, like I said, to grow up and watch this industry evolve. And we have, 30 plus guys that are in the S&P 500 now.
Yeah.
Over 200 publicly traded REITs. And that's not even counting the world of private REITs. But, from a very core basic, we'll get into it. Yeah. REITs are everywhere. We're using a REIT right now to film this interview today. So investors are earning dividend income by you and I recording this nice podcast. That's just one example. And it's this daily usage of properties that have made me so passionate about education. Yes, I manage 2 funds. Yes, I'm out there, trying to raise money and everything. But if you don't understand what it is this industry does, why we use it every single day, and it should be a core component of any investment portfolio. Frankly, I don't care if you're an advisor, an investor, a developer, whatever. I tell folks, I don't care if you buy my funds. I could care less if you buy my ETFs and stuff. I wish you would, but if you don't, that's okay. I want you to understand all the great stories that are out there. Do your own due diligence and learn about this industry and the long-term income generating potential opportunity you have investing in some of these names that could be the difference between, frankly, 6 figures and 7 figures in your retirement, depending on when you start investing in the sector.
Yeah. So, I mean, it's funny, though, when you're just looking over this little line and you didn't know it was going to be REIT. So you didn't know it was going to have anything to do with real estate. And I'm assuming from conversations we've had in the past, like you were just like, look, stocks is my thing. The market's my thing. But then it turned out to be this kind of hybrid, which is what REITs are as we get into discussing them, right?
Yeah, absolutely. It was just, I never even knew what a REIT was. I remember being in a finance class and growing up in school, and this professor, I'm not exaggerating, spent 5 minutes talking about it.
Yeah.
When I got my MBA, and again, I took a real estate class, and my real estate professor spent about, an hour on it, and I was raising my hand, and every single time he's like, "Mr. Auerbach, do you just want to come down here and teach this portion of the class?" And I'm like, that's an insult to you since you wrote the textbook on it, but I shouldn't be correcting you about your REIT knowledge. So you're right. I had no idea what I was walking into. And I'll be frank and honest. There's still a lot of stuff I don't know all of these years later. I remember growing up, again, my boss would tell me, you're either an analyst or you're a trader or you're in sales and marketing. You can't do all of it. You either get your MBA or your CFA. You don't do both. And so when I went down the trading and marketing route, the analyst hat, the guys that write the research reports, do the net asset values, all this stuff, is a whole different world of knowledge than what I've been doing in my years. We talk to a typical Wall Street analyst and say, hey, show me your model on realty income. And it's 20 tabs long, it's 1,000 lines long, the spreadsheet. And you're like, oh my gosh. But they could jump into that and show you the key numbers and, here's the mover, here's the number. Like, again, they're just on a whole different level.
Yeah, and that's the interesting part of REITs. It's able for somebody to invest in something that's much larger than they would have access to on their own, but trust experts who have done, like you said, 20 tab spreadsheets, millions of dollars of research on it, that they're putting the things in the right spot, which again will help with a diversified portfolio, which I know we're going to talk about.
And you just hit the nail on the head about why REITs, because anybody can invest in REITs. Not anybody can go out and contribute as a GP or an LP to go out and develop a property. Not everybody can just go downtown and buy an office building or, pick your favorite property and buy it. But with REITs, one of our funds is trading around $10 a share. You can buy our fund at $10 a share and have be again a very tiny fractional owner, but you could own a fractional unit of tens of thousands of properties coast to coast.
Yeah. And again, that's the hybrid part that's interesting to me, because we've had a lot of shows on syndications, and obviously that's another way to get into what's more passive. But as you said, you have to qualify for that. You don't have to qualify for buying into a REIT. It's just something that you can grab along with anything else that you're interested in. And I too didn't know about it growing up. My dad also handed me the Wall Street Journal, and at the time Newsday, and I was looking at the baseball box scores, and then I was looking at the stock ticker next to it. And I found a great similarity between them. I was really into numbers and stats. So I would just obsessively look at the stocks. And over time, as I got to about 13, 14, he gave me some money and said, yeah, let's do something. I said, well, what happens if I lose? He says, well, then you lose. But this is how you figure out the market. And it was, as you said, I was the same way. I'm looking at them like, wait, these are companies that I know. These are some that I don't know, but then I would see things near something I know. I'm like, wow, that's going up. I wonder why, and do the research. And I think people can really find an interest in it that they didn't think existed before. And even if you think you're only real estate, here's a way in that's again more accessible and a little bit leveraged in a different direction.
And you've covered this so many times before, and I always emphasize this. Unlike a lot of the other sectors that are out there on Wall Street, at least with us in the world of real estate, you can observe your investment in real time.
Yeah.
Look at a shopping center that's owned by Kimco or Brixmor as an example, because I have a Brixmor shopping center that's right down the street from me. I can drive by that property 24 hours a day, observe, look at the foot traffic, look at the store traffic. Is the light out on the sign? Does this need renovation? And this is just one example. But when you think about the population around one of these properties that we interact with every single day, again, versus NVIDIA. How do you track NVIDIA or Microsoft on a day-to-day basis? You can't. Yeah. You can track Walmart and Costco, again, by looking at the parking lot and seeing the number of people that are inside the stores. Yeah. Again, which is a good real estate physical observance, shopping center, a TJ Maxx, whatever it is. You can look at this traffic and really make a judgment of, oh, okay, this is interesting. This is something that I want to invest in. Oh, wait, who owns that shopping center at this corner? Brixmor? What else does Brixmor? Oh, they own this other property. I know this. And then the snowball starts rolling down the mountain. And then you become a more educated investor. One thing I like to tell folks, and if there's anybody who's watching this, I always emphasize, with the world of real estate investment trusts, especially the public guys, they have great investor relations departments. And these folks, their job is to interact with investors. Ask the questions, pick up the phone, call, ask questions. Don't be afraid. Management teams want to engage with advisors and investors because, again, it's education. We use these properties every single day. And if you don't understand how you can earn dividend income by going and getting the cup of coffee or filling up your car with gas, as an example, this is an opportunity versus buy my newsletter, buy my ETF. That's not how they lead. It's investing with your eyes.
Yeah. And again, it's something, a lot of things that we talk about are accessibility at different levels. Like you were saying, not everyone can go out, buy, a 4-family because the down payment's a lot. And maybe they don't want a management. Some people can't get into syndications. They don't want to get into turnkey because they don't want to, it's too far away. And then we go all the way down to the bottom, which is land flipping, which is very simple. You can buy very small parcels of land, but you still have to figure out how to sell them. Stocks and a REIT in particular, this is an option where you can just go on and buy them. You can buy one share if you want. You can buy more shares, right? This is real estate available to the masses in bulk, but as you said, also viewable. You know what's in there in general.
One more thing to build on, not only are they investable, some of these REITs offer what they call DRIPs, dividend reinvestments. And so, when anybody's like, well, what REIT should I buy? And I go, okay. And I will preface this as everybody. I'm not making buy, sell, hold recommendations. You need to do your own diligence, blah, blah, blah. I tell folks, go out and buy one share of realty income for your child that was just born yesterday. The kid's 1 day old. Go out and buy one share of realty income and set up a drip.
Yeah.
Watch what happens through that drip over the course of 10, 20, 50, 100 years, how much income is generated because of the re-rolling those dividends. Part two of that. Again, REITs are income vehicles. Look at the number of REITs that pay monthly dividends. Not necessarily just quarterly dividends, but monthly dividends. I mentioned realty income. Their tagline is the monthly dividend company. And they've paid a monthly dividend for, hundreds of, I don't want to say hundreds, but a lot of months in a row. The goal, again, for the end investor, pick your favorite stock on Wall Street. Doesn't have to be a REIT. Pick any stock. You, the end investor, want that company to do four things, really, at the end of the day. Grow their revenues, grow their profits, grow the dividend, and grow the annual guidance. We did $2 to $2.10 last year. We're going to do $2.10 to $2.25 this year, is my example. If the company is able to do all of those things, then you don't care what's going on with the broader market that's out there. You just want them to be, laser focused on maximizing revenue growth, minimizing the expense growth, growing the profits, and then passing that out through shareholders in the form of dividends, because that's what a REIT is. A REIT is basically just a tax-structured vehicle that passes income through to shareholders in the form of dividend income.
Yeah, so describe for the listeners what's inside a REIT. If they buy into a particular REIT, what are they getting inside of that? I know it's different for each one, but generally, what's packaged in that?
Well, again, it just depends on the sector. You buy an apartment REIT, you're getting, again, a fractional interest in thousands of apartment properties across the country, or shopping centers, or office buildings, whatever it is. But you are owning some of the best real estate at what we call the intersection of Main and Main, where there's the most population, high net worth, whatever it is, location, location, location. And so you are basically owning a physical piece of real estate through the stock market across coast to coast. Now, are you, let's say, Rexford Industrial, and you're just owning Port of Los Angeles industrial warehouse properties? Are you MAA, what used to be known as Mid-America, and you own apartment properties across the Sun Belt? Are you Postal Realty Trust, and you own a fractional interest in post offices across the country? Do you own Easterly Government Properties, which is a very interesting name that's going through a lot of stuff right now because of what's going on in the world of Doge and government office leases? If we'd have this conversation any other time, I've always really liked the guys at Easterly, because again, they are the office landlord to the TSA, the FBI, a lot of these agencies that are unfortunately in the crosshairs right now. So there's a lot of uncertainty that's out there. Let's be blunt and honest. But of course, you are owning the revenue stream and the income stream that these companies operate in. And remember, these teams have been in place for many years. These are companies that own, you could own a hotel REIT that has 30, 40 properties. You could own a self-storage REIT that owns, 30, 40, 50,000 units or more. Again, it'd be a lot more than that. The answer is it just depends. But that's the cool thing about these REITs, because there's so many properties under the hood, it takes a lot to move the needle. So as an example, there's small cap REITs, the smaller names. There's large cap REITs, the guys in the S&P 500. Well, let's use a large cap REIT as an example. Everybody's heard of Public Storage. Public Storage is one of the largest self-storage REITs that's out there. And so if Public Storage goes out and buys a property down the street here in Dallas, it does absolutely nothing to the bottom line because they own so many properties. The only way the companies of that size grow is by buying other properties or buying other companies, big portfolios. Now, that 30 property hotel REIT, as an example, if they go out and buy one property, you can track the earnings growth. There is some material earnings movement from that one investment. So again, it just kind of depends on what you're focused on, where you're focused on, and what your time frame is. And when I talk to folks about REITs, I usually emphasize, with this sector, you've got to look at it with 25 to 50-year lenses. If you want something short-term, go out and buy yourself a hotel REIT, because that's the shortest lease contract that's out there. One night. If you want to take it up a level, you go out and buy an apartment REIT or a single family rental REIT. We can get into that. That's a whole hour in itself.
Yeah.
But you go out and buy a single family rental REIT, and that's a most likely 1-year contract. But then you've got the net lease guys, the office guys, the shopping center guys, and you're talking 5, 10, 25, 50-year leases. There's a ground lease REIT that's out there called Safehold. We can go into that. But those ground leases are 99-year leases. So we're having this conversation today on Liberation Day +1. And as a result, there's a lot of uncertainty that's still out there. But from the lease perspective, that 5 to 10-year lease, did anything truly change versus yesterday? And at this point, the answer is no.
Yeah.
Look at office as a good example. I don't mean to cut you off, but look at office as the perfect example. New York office is dead. We're never going back to the office. But the office landlords, some of these guys are 95% occupied. One Vanderbilt, which is tied to Grand Central in New York, owned by SL Green. It's like 98% occupied. The physical occupancy, the number of people inside the office building every day, isn't 98%. The landlord, again, they put amenities in place to draw the tenants and the inhabitants to the office. But the landlord really, not to be rude, but the landlord doesn't care if the bodies show up. The landlord wants to lease the space out and collect the rent. It's on the tenant to bring the employees back. It's not the landlord's responsibility to make sure you go to the office. It's your company that makes sure you go to the office. So when people talk about the headlines in the world of commercial real estate, I always emphasize it's important to peel back the layers of the onion. Go to the company level, company specific, because REITs as a whole really are just a blip on the world of commercial real estate radar. It's just one tiny slice of the bigger pie that's out there. Same thing with public REITs and privates. Again, maybe we're starting to talk about private REITs that are out there, which is a whole separate class. Mortgage REITs, again, a whole separate class. But there's so many different REIT type of properties that are out there that, as I like to say, there's a REIT for somebody everywhere.
Yeah. And I mean, again, I'm just thinking in my head as you're going, it's like, oh, well, syndications, but that requires a bigger intake. Are REITs generally organized among asset classes? Because a lot of what you said were, you have these specific asset classes in a REIT. Are there others that are organized in a different way to be, I guess, more diversified asset-wise instead of just diversified geographically within an asset class?
So that's a great question. And the blunt answer is there's less diversified REITs than there were many years ago. And the reason being, the cleaner the story, the easier it is to sell to your end investor. And if you own, let's just say, office and resi, that's two completely different stories.
Yeah, it makes sense. And
sell layered stories.
Yeah, and again, I see that in the syndication world, the people who are focused are like, look, we're multifamily. If they just were all of a sudden to toss in retail, no one would think they really knew. But you can get the diversification within an asset class by being geographically diversified. But as you said, we're recording on April 3rd, 2025. This is going to come out in June. And there's a lot going on with tariffs. So the thing that I think with just news, and I have for years, I don't look at the news at all, haven't in 10 years, take little drips here and there from small sources, is that people can overreact to things that are happening. Because you could react to something that happened yesterday on April 2nd, and then 2 days, things could be changed. We're seeing like a very interesting cycle of things changing within a day. Tariffs go up. Oh, wait, now we're going to negotiate. And then a change. And that could change the entire landscape of one REIT, of people selling and moving too quickly. And isn't the point of REITs holding them like through all the cycles?
You're hired. You're right.
My dad taught me this, though, and I've gone away from it. But that's why I'm really excited to talk to you about this, because real estate is a long-term game. It should be for everything. But people like the short-term rewards. If you're a short-termer, you shouldn't get into REITs, right?
So you couldn't have teamed me up any better, because as you're talking about this, and I know, again, this is going to be a couple of months from now, but there's going to be a case study that people are going to come back. Do you remember meme stocks during COVID?
Oh, yeah.
Memes. So
GameStop.
Right now there's a meme stock in April that we're dealing with, and it's Newsmax. And Newsmax isn't a REIT, but why do I mention Newsmax? They priced a Reg A offering directly to shareholders at $10 a share. 2 days later, the stock was at $250.
Meme
Right
stock's
now,
crazy.
because I haven't pulled up a quote today, and I'm curious, right, and they rang the opening bell today, actually. But right now, the stock is at $45.42.
Oh my gosh.
So just picture that chart in your head, a 3-day chart, 10, 250, $45.
Yeah.
And I did a LinkedIn post yesterday. Things this REIT guy is thinking about. Number one, who bought it at 10 and sold it 250? Who bought it at 250 and how are you feeling?
Yeah.
Are advisors out there recommending this stock because of the opportunity to get rich quick, potentially? Who's holding it at 45 when it was at 10? You know what I mean? Like, okay. All right. So why REITs? What's going on with Newsmax emphasizes the why of REITs, and you teed it up.
Yeah.
You think about this with a long-term lens. REITs are not day trading vehicles. If you want to day trade, REITs are not the sector. I always tell folks, REITs are the tortoise and the hare of your portfolio. Slow and steady wins the race. REITs are the ballast of the ship. It keeps your ship afloat. It lets you play NVIDIA and inverse levered ETFs with an options overlay or whatever it is. There's very, very risky strategies that are out there that advisors are, selling to investors, that investors are reaching out to advisors and saying, I'm interested in this. Do they understand it? If I don't understand it, and there's a lot that I don't, what makes you think that, again, grandma and grandpa, when they see a commercial or they see a guy on CNBC talking about it, oh, I like what he said, I want to buy it, and they buy this thing at $250 hypothetically, and the next day it's $100 because it was a levered inverse fund.
Yeah.
You're the one left holding the bag, right?
Yeah.
So this is why I'm so passionate about education, because you nailed it. You buy REITs for that long-term income stream. You don't buy it for day-to-day volatility. The REIT appreciation is a two-part equation. Number one, the dividend income side of the growth, and number two, stock price appreciation. Well, as I tell people about my ETFs, they're like, "Oh, your thing's been at $10 for a year. You trade in the span. Why would I buy your ETF?" And I go, "Yeah, but you forgot about the monthly dividend we paid you, so add that back into it." But number two, wouldn't you rather be in this narrow band than being in this situation with Newsmax? Slow and steady. My growth is determined on my constituents' growth. I have no control over my stock price. The companies themselves tell you, I have no control over my stock price. All I can do is focus on operations and the bottom line because I'm concerned about my investor, which leads to one more point. A couple of years ago, I was in Memphis. I was interviewing the CEO of Mid-America, or MAA at the time, who has subsequently retired. His name was Eric Bolton. He's very approachable and he's a nice guy. Why do I mention this? As I'm doing my interview, I ask him point blank, Eric, you've got a lot of money. You're a CEO. You don't need to work. You know, what keeps you up at night? And with no hesitation, he looks me dead face and he goes, how to keep finding ways to raise my dividend. Like with no hesitation. And that made me feel good because remember, with these REIT management teams, because of the amount of dividends that these companies pay, the dividend yields and all that stuff we're going to get into, a portion of their compensation is obviously tied to stock. So if I own, hypothetically, 100,000 shares of stock and we increase our dividend by 1%, guess what? My quarterly bonus just went up by an incremental amount. So as the company grows, so does their compensation, and they're just as aligned or what we call entrenched with shareholders than a lot of the other sectors that are out there. Again, because you're getting for some of these guys, 5, 6, 8% yield. And for quality, you know, again, depending on the name, 3, 4% yield, which is pretty strong, especially on like days that we're seeing right now.
Yeah. Hey, it's Jonathan. I hope you're enjoying this episode with David Auerbach. And if you want to join the REIT Beat and beat that drum like I've been beating, it's pretty simple. Go to the Daily REITBeat, and REIT is REIT. So the dailyreitbeat.com, right at the top, you're going to see a button that says subscribe. Click it, add yourself to the mailing list, find out all about REITs, talks about stocks as well, and goes over all the REIT specifics every day of the week. Let's get back to David. I was thinking while you were talking just about the kind of what people are looking at, as you were saying, oh, somebody sees a commercial or something, but now someone could see something on TikTok and think that it's a great investment. Literally 20 seconds by some rando kid on TikTok, and they're like, oh, this is something I need to buy. And that's making it harder for everybody else. There's so much information coming out there on the news and everything that it makes it harder to decide. So for me, someone who is an admitted control freak, I find opportunities like this help me as a control freak because I can't control it. So I'm making a conscious choice to invest in something, trust experts, and then just leave it alone. I do think that when you're investing long term, you should do it with income that, of course, you don't need back. But that's a lot of times where people make mistakes. And then they see this on the news, yesterday, oh, tariffs are adjusting, my good REIT that I just bought, and then they want to sell it. And that defeats the whole point of buying REITs in the first place. Am I right on this? I mean, it just seems like a smart move for me.
Yeah, you're absolutely right. And I think, this plays into another benefit about REITs, and it's called transparency. With the publicly traded guys, remember, they host quarterly earnings conference calls, a lot of regular press releases, a lot of investor presentations. They get ahead of this. So it's all about, what we call creating that narrative. What is that story? Why is that story relevant right now? So again, Liberation Day +1, the hotel guys are taking it on the chin right now because we may see the slowdown in travel potentially. We don't know where this is going. In the same breath, this is opportunity for these companies to say, okay, yeah, our stock price is down, but let me ask you a question. Are you still going to go take your kids to go see grandma and grandpa this summer? Yeah? Well, you're not going to stay at the Peninsula or the Ritz-Carlton when you go to grandma and grandpa. You're going to be staying at, a limited service, a select service, something more affordable, right?
Yeah.
So these properties that we're still using, doesn't necessarily change in what's going on. However, tariffs, rising costs, cost of cup of coffee goes up, etc. If you go back a few days before all this came out, I would tell you, look, when I got Starbucks this morning because I actually ran out of cold brew in my house. When I woke up this morning, I think to myself, gee, where's the 10-year Treasury at? What's the Fed doing with interest rates today? Can I go and get that cup of coffee? And of course not. Of course I don't think about that. I'm out of cold brew. I need a cup of coffee this morning. I'm going to get my cup of coffee. And until Starbucks tells me, hey, that $5 cup you just got's now $10, okay, that's a problem. But wait. Did you know that this same $5 cup of coffee has, I'm not exaggerating, 20 different price points across the country? That if you're in New York City, this cup of coffee is different than how much this cup of coffee would cost you at the Harrah's Hotel on the Las Vegas Strip, as an example. Like, there's still
try to get an airport Starbucks. Good luck on that. It starts at $10, I think, for a crumb.
Great example. So until it really gets to that level, we're still going to go and live our lives. Look, here's another great example. One of my favorite stocks that's out there, not saying buy, sell, hold, but one of the great stocks that's out there is called Vici Properties, VICI. Why do I mention Vici? Vici is basically the landlord to the Las Vegas Strip. And if you look back at what happened during COVID, the Strip was closed, right? There was nothing going on in Las Vegas. Do you know what the top performing REIT was during that period, during COVID?
Just going to guess it was Vici.
Because all of those casino tenants were paying the monthly rent because they were looking at this on the other side. We're going to come back. It's going to happen. So Vici, which owns Vegas, and they're the landlord to the Sphere, as an example. They own the ground on which the Sphere sits on, and all the stuff that's happening that's out there. This is not their first rodeo with travel volatility.
Right.
Do you think that MGM and Bellagio and these guys woke up yesterday afternoon like, oh no, none of our consumers are coming here because of what's going on? We're still going to live our lives. We may be a little bit more, let's say, cautious or, think a little bit more. But again, you got to peel back the layers of the onion. There's still a lot that we don't know. We may not know some of this stuff for 6 months, for a year. But you know what's going to happen? These guys are going to keep paying their dividends 6 months a year. From a very high level, I know we're going everywhere. When people ask me about REITs, like, what are good REITs? What's the REITs? And I go, look, let's put it this way. Your graduating class in high school had 200 kids, and it's like a bell curve. You had your top 10%, the valedictorian, the great guys. The middle, you had your bottom 10%, the troublemakers, the bullies, the guys that were in detention every day, but they all graduated, right? Replace the word graduating class in high school with the word REITs. You got 200 publicly traded REITs. You got the top 10%, the bell curve, the S&P 500, the largest names. You've got your troublemakers, the guys that cut their dividends, that are over-levered. They're the ones that are getting all the headlines on days like today when there's volatility that's out there.
Yeah.
But there's still 180 great stories that don't get the time or attention because, again, the CNBCs, the Bloombergs, the Fox businesses, the TikToks, you name it, they're highlighting the needle in the haystack, that one story that's drawing the headlines. When there's 25 guys be like, well, this doesn't impact us. This isn't us. Cannabis is a good example. One company is going through a lot of stuff with one of their tenants, but there's 7 other companies that sell off in sympathy because of what's happening at the big boy. And these guys are like, we don't even have this tenant. We're not even exposed to this guy. Why are we getting hit in the face with it? So that's why it's so important to really peel back the onion and do the due diligence on these companies. Learn what you're investing in. Observe.
Yeah, and also invest in things that you want to stick with for the long term, and don't look for a way out. You buy a REIT, and then if you're every day, sure, you want to see how it's performing, but if you freak out one day when it goes down, you're just not going to be a good stock investor. Welcome to stock investing. It's like a yo-yo.
If I own Newsmax today, I'd be sick over a toilet right now.
Right. And yesterday you think you're buying an airplane. These are but that's the thing. I think you have to look at it again for everybody. I'm sure you counsel people. You have to understand what their risk tolerance is, why they're doing it, and that affects what they should invest in, right? If somebody really wants in and out in a month, you're not going to recommend the same things. That's for somebody else. They obviously, and if they want to do that and also have a low risk tolerance, I don't know, those two things don't match up.
But how do you invest, again, using that mindset, how do you invest in hard assets? How do you join a GPLP fund? How do you go and join your buddies to go out and buy this building? Because there is no liquidity. You aren't getting it.
None.
And with REITs, with our ETFs, et cetera, they're publicly traded. Now, the Blackstones of the world, the B REITs, the S REITs, that's a whole different conversation that's gone through their share of turmoil over the past couple of years as far as gating investor redemptions and clients can't get their money out.
Yeah.
But the publicly traded guys, they're trading on a bid-ask spread during market hours right now. You know where you can buy it. You know where you can sell it. You know what the market is. Even if the tape is this volatile, what we're dealing with right now, it's still transactable. You can get in, you can get out. You want to sell that office building? There's no guarantee you're getting out of that property. Imagine you own a Class C office building in New York City right now when everything is basically being bulldozed. Your hope is somebody's going to buy that to tear it down and build something else new. Because if you're sitting on again, me speaking off the cuff, I don't have any proof of this, but if you're sitting on a 1940s era Class C office building that's got mold and asbestos, hypothetically, to quote Liam Neeson from Taken, good luck.
Yeah. Yeah. But you make a great point about liquidity, and that's where the differentiator is between syndication investing, again, which requires a higher input, and REITs, is that we're saying you should be holding them for the long term. You should be looking at a 25, 50. But if you get panicked, you can just set it to sell. That's just part of it. That's a much more liquid asset than syndication, which is completely illiquid. You cannot get your money out until the cycle's complete.
And frankly, that syndication is geared to a whole different investor. That's the guy who doesn't mind locking up $100,000, $1 million. They are a sophisticated investor. They've got the net worth. They can justify it. But, why REITs? Okay, so, the buzzword last year was crypto, Bitcoin ETFs. Okay, go to talk to your typical advisor. You're an investor. You're ready. You're doing your annual portfolio review, and you're like, Mr. Advisor, what percentage of my portfolio should be in Bitcoin ETFs? And the answer is, we don't know. There is no answer.
Yeah.
What about like ESG, do good funds, DEI, whatever it is? And again, I don't know. Mr. Advisor, Mrs. Advisor, I've been learning about real estate. I happened to see Jim Cramer interview the CEO of Realty Income yesterday. What do you guys think about REITs and real estate? Oh, we recommend clients are in 5%, 10%, 8%. Every shop, cautious of my language, most shops have an allocation model that a piece of the pie goes towards REITs and real estate. Why? Again, it goes back to what we've been talking about for the past 30 plus minutes. It's that dividend slice, that income component that is the hedge, the diversification, whatever you want to call it, to all the other stuff in your portfolio. Bonds, fixed income, equities, international, large, small, you name it. Real estate's one of those pieces of the pie. Look, it's so big, it got its own S&P asset class a couple of years ago. They broke out REIT and real estate into its own separate category. So it tells you that, there's a lot of interest in this sector because there's so many different types of investments that they're out there. There's 18 different REIT sectors, I think.
Wow.
And that's really getting into the weeds. Billboards is an example. I mentioned cannabis, telecom, data center, towers. You order a package off of Amazon.com, you use 3 different REIT sectors as an example. REITs are everywhere.
Is there a specific REIT sector that you think is more likely to do well? Or is the landscape right now in America just like, we just don't know what's going to happen? You just have to invest in assets that you think are recession resilient, at least.
So it's a little bit of both. I would say those that have the longer term leases that are in place, again, like a net lease type of property, and maybe some of the office that have, again, office with an asterisk, because who knows what's going on at the tenant level at this point.
Right.
The tower data center guys, again, some of these sectors of industrial, they're the longer term sectors, I feel like, are the places to be. That short term volatile 1 year place might be a little bit, but we're still at our firm, we're still very bullish on the housing side of it, the resi REITs.
I agree. Completely agree.
Because you can't buy a house. There is no affordable house that's out there. Mortgage rates are still extremely elevated. We might see some changes. I mean, again, I don't have a crystal ball. Lord knows I don't know Jack. If I did, I'd be talking to you in Fiji after flying my private jet over there yesterday. Because I cashed out at Newsmax at $250.
Right. Yeah.
But in all seriousness, I think about the long-term situation of what's going on in the world of housing, the supply-demand imbalance, looking at the next generations of consumers that are going to be buying houses. Look, at the end of the day, there are folks that will never be able to buy a house. In certain markets, they will never be able to buy a house. They will be perma renters their entire life. And until the cost of delivery comes down, which at this point is not, because, again, rising construction costs, it's going to be the apartments and the single family rental players that benefit from this demand. Here's another sector of housing that people don't think about as much, and we do. Senior housing, the nursing homes, retirement homes, where we're going to be, unfortunately, for the next chapter. But thinking about your kids today and where they're going to be 50, 60, 80 years from now. Where I'm getting at is that's another sector that's going to be completely turned upside down. New product, new players, new amenities, new everything. And with the senior housing product that exists today really is going to look completely different 10, 25, 50 years from now, thinking about where that consumer is going. For a lot of these REITs, when people are like, well, why should I be buying REITs? What do they know? You know that old hockey analogy, where's the puck going? You want to try to be where the puck is going, not with the puck, but where that's how these REITs operate. Where are the migration trends happening? Where's the interest? Where's the wealth shifting towards? What industries are picking up employees, going away, onshoring, nearshoring, reshoring? It's where's the ball going towards the goal, right? So that's how these REITs are thinking about it. It's not, what's going on today, but in the same breath, there's somebody on the team, a team inside the company that's focused on the 10 years from today. Okay, guys, we're going to, So as I like to say, it would have been great to try to be 5 years ahead of investing in Raleigh, in Atlanta, in Nashville, in Charlotte, where the puck was going at that time. So here's my question. 10 years from now, is Omaha the next Raleigh? is Milwaukee the next Charlotte? You know what I mean? Like, and that's what these companies are focused on, is where's those migration trends. Do you know what two of the hottest apartment markets are in the country right now? Chicago and that area, and New York City and that area. People are always concerned, New York's dead. They're not going to go back to New York. And they've been going back to New York.
That's just a news cycle.
Chicago. What's it in Chicago, Milwaukee? They're going to Chicago, Milwaukee in droves. So if that's where the jobs are going, guess what? That's where the developers are going to start focusing.
Yeah, that makes a lot of sense. And I'm happy that I'm in a multifamily syndication in Chicago, so that helps me out. Thanks for that. In a typical index fund, as you were saying before, is there usually an allocation for REITs inside of that kind of 5 to 10%?
That's a great question. And the answer is yes, but. Because again, for those index funds, they're going to be focused on the large cap names.
Yeah.
For us, we focus on small. We own large caps, but we skew it towards the smaller and mid cap names because those are the needle movers. That's where you get the yield is on the small and mid cap names in the preferred stocks, some of the liquid REIT preferred stocks. That's where you can get some incremental yield.
Yeah.
But this is a great answer to your question, actually. Why are REITs technically out of favor right now? We're getting more in favor a little bit, but why are REITs out of favor? And it all compares to the 10-year Treasury. So from a very high level, right now at this moment, it'd be great to revisit this when this drops in June, what the number is.
Yeah.
But right now on my screen, the 10-year Treasury is at 4.061, okay?
Yep.
Bookmark that. The average REIT dividend, if you market cap all the names, the average REIT dividend yields 4%. So what that's telling you is that at this moment, bonds are very slightly more attractive than REITs. Historically, it's been the other way, that the REIT dividend yield was closer, higher versus the 10-year being lower.
Yeah.
Okay. But remember I talked about the small and mid-cap REITs. So if you equal cap weight all the REITs, so everybody has the same weighting, that dividend yield goes towards 6% and higher. So you're basically getting, again, more smash in some of these other names that don't get that attention.
Yeah. And
that's why I think it's so important. Because so the two largest REIT ETFs that are out there are Vanguard and iShares, VNQ and IYR. But remember how we talked about what's under the hood? Do you know what you're buying? Yeah. Well, with some of those guys, you may not be buying REITs. You're buying operating companies. You're buying mortgage brokers. You're buying lender. You know what I mean? Until you actually want a true bread and butter, pure REIT fund that's out there, you really have to be select in what you're looking at. So I think that's why when people are always looking at at least for us in the 10-year Treasury, it's what's REIT yields versus where the 10-year Treasury is at. And I've always used 4% as the magic number. Yeah. If the 10-year gets below 4%, that's great for us. If it's above 4, goes to 5, not so good. But one thing that we haven't talked about really is the Fed. And Fed interest rate policy kind of dictates where bond policy goes, right? So if the Fed does cut 50, 100 basis points of where the interest rates are at, that's going to trickle down to the bonds as well. But the REIT yield isn't going to decline, right? So if anything, the cost of borrow improves, meaning I'm a REIT, I need to go out and borrow money. It cost me 5.5 yesterday. It's 4.75 today because we've seen this cut. So I have a call with the company later today. And why I mention this is I'm looking at their investor presentation, and they have a slide here on their investor presentation that talks about their upcoming debt maturities. And one of the things that a lot of people were hammering about real estate coming out of COVID was this commercial real estate wall of debt that's coming due. Oh my gosh, this industry is going to collapse because there's so much debt that's coming due. And what these companies all do, again, talking about that transparency angle, they put out a debt schedule. This is what's due this year, next year, the following year, 10 years out, 25 years out. They're telling you all of their debt and when it's coming due.
Yeah.
And if you ask the companies at the individual level, they will tell you, what debt wall of maturity? I've got 3 years to work this out, 4 years.
Yeah.
This piece that's coming due is only a tiny percentage of our whole, or if they were not to earnings, we have no debt coming due until 2027. I'm looking also at earnings. Until about a year ago, when a company announced earnings, because again, if you go back before COVID, REITs were firing on all cylinders. It was the place to be. You couldn't do no wrong. Things were great.
Yeah.
We take a hit during COVID. We come back. We surpass COVID. And these guys are like, hey, in 2019, we did X. Here we are 5 years later. We're trading at this discount. Our stock price is at this discount, but yet our result, if we were here in 19 as far as what our net income was, we're here. We're up here today so many years. So we've grown this much, but yet our stock is down here versus where it was in 19. What gives? These guys are telling you we are doing so much better than we were just a few years ago, but our stock prices aren't reflecting it. That's an opportunity because, again, we have upside. Same thing when it comes to dividends. There's a lot of catch-up still to do for some of these REITs when it comes to dividends. They could literally hit the accelerator and go back to where they were. But one of the reasons about why REITs, and I mentioned earlier, it's what do we learn from the last cycle that we can implement today so that we don't make the same mistakes that we made last time? What did we learn last time that we could help us going forward? And so one of the things they realized was, let's kind of save some money for a rainy day. How about we keep cash back so we know to be deployed more opportunistically? The smart thing about these management teams is, I'd like to say, because they've been in place for so long, they know when to go on offense, they know when to go on defense. They know when to go left, they know when to go right. They operate in this box because they ignore all the noise on a day like today that's being thrown at them and focusing on operations. And so if my number one issue is I've got a debt maturity coming due in 2025 this year, what's the market today? Where can I refinance this debt? What's going to be the impact to the bottom line? If I was at 3.5%, I'm going to 5% now. What's the incremental interest rate hit going to be that we have to take on? The two biggest expenses for a lot of these REITs are taxes and insurance. And if you're in a hurricane-ravaged state or a tornado belt and you've had a bad year, you really can't forecast where insurance rates are going, right? And what do? Hey, man, this is our expense. We got to deal with this. We know it's coming. We didn't know the extent to where it's coming, but we know it's coming. So how do we address it?
Yeah, it makes sense. I mean, I think those are things that people are going to have to look at on a wider scale. But again, you're not dealing with just one asset inside a REIT. So you're a little bit more protected than if you just bought into some Sunbelt, 263 unit, and then they had a tornado there. You're more exposed that way as opposed to the entire conglomeration of properties inside a REIT, right?
Yeah, exactly. And again, I mean, those guys have insurance when that tornado comes through, but you're not seeing that insurance payout for quite a period of time.
Yeah. Awesome. David, well, I really appreciate getting this REIT lesson. It definitely helped me open my eyes as someone who's invested in stocks since he was 13 and probably has a bunch of REITs in the index funds. But like you said, there are those larger ones where I maybe need to take a look at others. If people want to get in touch with you and learn more about what you do and specifically to get the Daily REITBeat, where should they go?
Sure. I mean, I'm kind of everywhere. I do have a website. It is thedailyreitbeat.com. You can sign up for my newsletter there. I am a presence on LinkedIn, on Twitter at Daily REITBeat. Hoya Capital is our research home. We put out content. We have a big platform on Seeking Alpha. If you follow Seeking Alpha for REIT research or any other research, I mean, you can access there. But we're very approachable. We're very accessible and always happy to answer any questions people have.
Yeah, awesome. Well, I really appreciate it. This has been a REIT lesson that was long overdue. But again, I really think it's an interesting corollary to a lot of things that we've talked about in terms of more active and more passive. And this is just another opportunity for people to have something to diversify their overall portfolio. So I appreciate you spending the time.
Thank you so much. I really appreciate it, John.
Yeah. All right. That was David Auerbach. You can find him at the REITBeat Newsletter or the REITBeat?
The Daily REITBeat.
The DailyREITBeat.com and HoyaCapital.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 249 of Zen and the Art of Real Estate Investing. And my guest next episode is Lon Welsh, 8 years in strategy consulting, 20 years in commercial real estate acquisition and development, and the founder and CEO of the largest independent brokerage in Colorado, Your Castle Real Estate. plenty of other things. It's a great show, and we go all over the map with investing, agent business, and everything in between. We'll see you next episode with Lon.